Welcome to our 2023 webinar series. Each month you'll learn about insurance solutions you and your clients can consider, plus the significant impact on insurers and their post-pandemic strategies. Each webinar will last about 50 minutes and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's webinar is being recorded and will be posted on our website. Today's presenter started working at LLIS in 1998. Since then, she's become LLIS's go-to person for connecting your clients with long-term care insurance solutions that meet their needs. Here to present on Securing Your Future, Long-Term Care Insurance Awareness Month Insights and Hybrids is Jill McNeil.
Thank you, Claudia, and thank you everybody for joining us this afternoon. As the title says, November is Long-Term Care Awareness Month. I don't think this month gets a lot of attention. Maybe some of you are not aware that it's Long-Term Care Awareness Month. I don't think there's any special ribbons or special colors. We're not going to see NFL players this month wearing special cleats or anything like that. But I recommend you think of it as a good month to talk to your clients about their long-term care plans, what they have designed for if they have a long-term care event in their retirement and how it would affect it. So let's get started. We're going to talk about some statistics and then different products, and then I'll give you some updates on different things going on in the industry. In the year 2030, there will be 73 million Americans age 65 plus. This is the year that oops, I'm sorry. So 73 million is 1.5 times the number of 65-year-olds today. And 58% of men turning 65 will need long-term care, some type of long-term care or some form of long-term care. And 79% of women turning age 65 will need long-term care. Planning for the future. 91% of Americans surveyed by Lincoln Financial believe that long-term care planning is very important. But only 76% believe that having a long-term care plan would provide peace of mind for them in retirement. And 50% are worried that they will run out of money if they have a long-term care event. So people are aware of the impact it may have on them, but are they planning for it? 62% of Americans surveyed have no long-term care plan. It's especially important for women to plan for a long-term care event. As we saw earlier, more women have a long-term care event for men, and this is why premiums for long-term care policies are more expensive for women. What usually happens is in a couple, the husband gets sick first, the wife takes care of him, and then he passes away, and then she has nobody to take care of her. And 73% of women do not feel confident they have financial resources to pay for a long-term care event. And 97% of those women feel it is important for families to talk about their long-term care preferences. You know, if the mom becomes sick, where does she want to receive her care, and who does she want to provide that care? Does she want to stay at home as long as she can? And if she does, are family members willing and able to provide that care for her? So, but only 12% of women have done so. Only 12% of women have talked to their families about what the long-term care plan is. So here I just want to give you an idea of what the cost of care is. And the numbers I'm going to give you are the national costs for this year. $65,538 home health care costs. So this is based on 44 hours of care per week. If your client wants more than 44 hours, if they wanted 24/7 care, it's going to be much more than that and would be even more than nursing home care. Assisted living, $57,289. Semi-private room in a nursing home, $100,679. Private room in a nursing home, $115,007. Again, as I said, these are national costs. Depending on where your clients live, costs could be either much lower or higher. Good chance it could be higher, especially if you're in New England, California, Alaska, even Florida. Prices are high. So it's important to look at cost of care with your clients when they're thinking about their long-term care plans and see what care is in their area. Genworth and Mutual of Omaha have good cost of care websites that you can consult. So when you talk to your clients and you discuss their long-term care plan, there's two ways that we generally think of funding a plan or taking care of this plan. Option one is to self-fund. So if they've decided they're just going to plan on paying for their long-term care through their own pocket and not buy a policy, what is the impact? What could the impact be on their assets and their retirement future? It could affect, if they have a long-term care event, it could affect their ability to pay their day-to-day expenses. If they have a nest egg and they're relying on that nest egg to fund their retirement, if they have an event that drains that nest egg, then if they recover, then their future retirement plans could be affected. And if one spouse has a long-term care event, that surviving spouse could be left with fewer assets. What's the impact on family members if they're self-funding? Well, they could become a burden to their children. So if they go through their assets and have to depend on the children to provide their care, maybe their children don't want to do this. Maybe they didn't plan on this. So I think you'll find your clients that have been through this with their own family members, either their parents or their friends' parents, they've seen them be caregivers. I think they'll be the clients that will be most willing to talk to you about what their plan should be. And if they're going to self-insure, if they have an event, there are less assets to leave as a legacy to their family. The second option is if they're not going to self-fund, they may want to consider transferring the risk by purchasing a policy, either a traditional long-term care policy or a linked benefit solution, such as a hybrid life policy or a hybrid annuity. The benefits of purchasing a policy, they can help protect their income and their assets. They don't have to spend down their assets to pay for care. They can rely on the policy to pay for not 100% of their care, a good portion of their care. And again, they can protect assets for the legacy. By having a policy, it provides you choice and control of when care is needed. You're not going to be as dependent on government programs and families. Maybe a lot of your clients think that they can depend on Medicare or Medicaid. Help them be aware that Medicare is only going to pay for 100 days, and Medicaid, you have to spend down your assets to a very low level to qualify for Medicaid. And by having a policy, you have a choice of care settings. Maybe you can stay in your home longer and receive care there, assisted living or nursing home. Many of these policies provide a care coordinator that will, once you go on claim, the policyholder goes on claim, a care coordinator will be sent by the insurance company out to the home of the policyholder to help them determine what type of care they want to receive. So they help them set up care in their home, provide a list of care providers in the area. If they've decided that they want to or need to go to a facility, again, the care coordinator will have a list of facilities available. They'll set up the plan of care and go over the benefits of their long-term care policy. They may have bought the policy several years ago, maybe 20 years ago, and they forgot what they purchased. So the care coordinator can help with that. And by having a policy, you're allowing your family members to manage your care, not provide it. Think of it as a gift to your family members. You're helping take care of yourself in the future. So when to purchase long-term care? This is a question I receive a lot. When should my clients consider looking at long-term care? So to answer this question, I put this chart together to show if a female purchases a policy and goes on claim at age 80, what's a good age for her to purchase? So let's start by looking at age 45. If she purchased a policy, her premium now $2,546. And if she goes on claim at age 80, she'll pay that premium for 35 years. So by age 80, she will have paid in $89,110. I know this is assuming there's no rate increases, but just to keep it simple, we're going to look at it this way. If she buys it at age 50, she's going to have to buy a bigger policy because the plan had 3% compound inflation. So over the 5 years, that benefit has grown. So she'll pay the premium for 30 years. She will have paid in $95,430. And you can see it keeps going up or up. You're age 65, almost $121,000. But then when she gets to age 70, premium starts to go down because we're saying she's only going to have to pay the premium for 10 years. So you may think, well, why not wait? Wait until you're older and purchase it then. Well, the problem is that client may not qualify if they wait till later in life to apply. This is a chart that I found that shows LTC declines by age group. You can see 49 below, only 12.4% declined, goes up a little bit each year or each age group. Age 70 to 74, 47.2% are declined. So almost 50% of applicants are declined. So yes, your client may save some money by waiting, but high likelihood that they may not get the coverage. What else should we look at? So we also need to look at family history. Long-term care underwriters consider family history when looking at an applicant for long-term care. If the applicant has had 2 or more immediate family members diagnosed with a cognitive issue, doesn't matter what age, it's very difficult to get coverage. Mutual of Omaha, it's an automatic decline. National Guardian Life is a possibility you may get coverage. Again, they would look at individual situation. So family history is very important. So the older your clients wait, the older their parents are, and more likelihood that they may have diagnosed with an cognitive issue. Also, the older the clients wait, they may be on Medicare, and Medicare provides health screenings that could reveal some medical condition making a client uninsurable. So if they take advantage of these Medicare health screenings, they could be diagnosed with arthritis or a cognitive issue themselves, making them uninsurable. So it's always best to apply early while premiums are lower and lock in their insurability. So let's look at long-term, different products on the market. There's several different products on the market. We're talking about traditional long-term care and hybrids here. What are some common features of these products? So common features of long-term care and hybrids. They all provide a benefit that can be used for the home, assisted living, and nursing home, and adult daycare. Choice of benefit periods, 2 years up to 6 years, and even some of the products offer unlimited benefit periods. Inflation riders, 3 and 5% are the most common compound. Some of the hybrids offer simple inflation. The 2 long-term care companies we work with, Mutual of Omaha and National Guardian, do not offer simple anymore, but they do have 3, 4, and 5%. So all these products have the same 2 claim triggers. So these are diagnosed with a cognitive issue. So if a medical professional diagnosed you with a cognitive issue and you need round-the-clock care because you're a danger to yourself, you could qualify. Or the other trigger is if you need assistance with 2 out of 6 activities of daily living, which are eating, bathing, dressing, toileting, transferring, or continence. So same claim triggers for all these products. What are the differences in long-term care and hybrid policies? So no death benefit with traditional long-term care. There is with hybrid life, and with the hybrid annuity, when the insured passes away, their beneficiaries would receive whatever is left in the in the annuity value. No return of premium with traditional long-term care. There is with many of the hybrid life policies and the hybrid annuity. Premium payments. Traditional long-term care, we generally think of lifetime premiums. So you pay the premium until you go on claim. NGL does offer a 10-pay and a single pay, but the majority of traditional long-term care products are lifetime pay. Hybrid life, they're designed to look the most attractive with a short pay premium, like a 5-year or single pay or a 10-year premium. Some of the companies do offer a lifetime premium, but if you go with the lifetime premium, chances are you're going to end up spending a lot more money on premium than if you did like a 10-year premium. The hybrid annuity, the only option for payment on that hybrid annuity is a single premium of non-qualified money. Premiums on traditional long-term care are not guaranteed. So the insurance company can go to the state and ask for a rate increase. If the state approves it, then every policyholder in the state has that rate increase. Hybrid life premiums are guaranteed, and the hybrid annuity premium is guaranteed. Form of benefit payment. With traditional long-term care, all the policies on the market now are reimbursement. So this means once they go on claim, satisfy the elimination period, the policyholder has to continue to pay for the care out of their own pocket. Then at the end of the month, submit their invoices to the insurance company, and the insurance company would reimburse them up to their daily or monthly benefit. And all care has to be provided by certified or skilled care providers. Cannot be provided by unskilled caregivers like family members or friends or neighbors. Many of the hybrid life policies are indemnity policies, which is very nice. So indemnity, think of it as a cash benefit. So once on claim, satisfy the elimination period, the insurance company will reimburse the policyholder beginning of every month. So it sends them a check, no need for the policyholder to submit invoices, and care can be provided by anybody they want. Can be family members or friends or neighbors. So very nice to have an indemnity benefit. Hybrid annuity is reimbursement just like the traditional long-term care. Underwriting. Full underwriting on traditional long-term care and hybrid life. The underwriting does vary a little bit with the two products, and I'll get into that on the next screen. The hybrid annuity has limited underwriting. So there is some medical underwriting, but it's not as extensive as it is for the other two products. So we've had several situations or several cases where somebody could not qualify medically for the other products, but they could qualify for the hybrid annuity. Partnership qualified. So traditional long-term care does qualify for the partnership program, meaning that if they go on claim, use up their policy benefits and apply for Medicaid, they would be able to protect some of their assets. The hybrid life and the hybrid annuity do not qualify for partnership. So let's talk a little bit more about underwriting. With traditional long-term care, the underwriters are concerned about medical conditions that would impact the insured's ability to perform the activities of daily living. So they're concerned about muscular or skeletal issues. So think about it as arthritis or physical therapy or undetermined, undiagnosed pain. So things that would cause them to go on claim sooner than somebody else. With a hybrid life, the underwriters are concerned about the ADLs, the ability to perform ADLs, but they're also concerned about pre-existing conditions that may affect their mortality. So when you think about it, a hybrid life policy is a permanent life insurance policy with a long-term care rider. So they're underwriting it for the life insurance and the long-term care. The nice thing about a hybrid life is many times you do not have to have an exam as long as you've seen your primary care physician and had a lab work done in the last 24 months. Okay, here's a case study that I put together to look at the difference between the products. So here's Doug and Debbie. Debbie's age 55 and Doug's age 58, and they live in Dallas, Texas. Debbie's mother has dementia. So Doug and Debbie have experienced firsthand what her mother has gone through. They've been the care provider. They know that Debbie's mother has gone through her assets with care. So they're very concerned about their future and they want to know what their long-term care options are. You can just So we would start by looking at cost of care in Dallas. Oops. The median cost for home health care in Dallas is $5,158. And again, this is based on 44 hours of care per week. The average cost for assisted living is $4,450. Private room in a nursing home, $8,975. So if they wanted a policy that would cover 100% of the costs, it would be very expensive. Most of your clients probably have some assets saved that they could use to help supplement. And 73% of long-term care claims begin in the home. So what I would recommend is they purchase a policy that would cover at least 100% of home health care costs. So if they had a policy with a monthly benefit of $5,160, they would have 100% of home health care and assisted living cost covered. Worst case scenario, if they ended up in a nursing home, then they would have 57% of those costs covered and would have to supplement with their own savings only 43%. So very expensive to cover 100% of cost of care, and most people don't need to do that. So look at cost of care for home health care, and to have a nice policy, consider covering 100% of that. So the company that had the lowest premiums for Doug and Debbie was NGL, and they use a daily benefit. So $170 a day is the closest I could get to that $51.60 monthly. Recommend I look at a 90-day elimination period. That's the sweet spot on these policies. 3-year benefit with a shared care rider. Why do I say 3 years each? Average length of care a male needs is 2.2 years, a female 3.7. So, and we add the shared care rider on, so it's like they're sharing 6 years between them. So that covers the most likelihood of events. Only 20% of long-term care claims go more than 5 years. And we look at a 3% compound inflation rider on the policy. That means the benefit will increase by 3% every year on the policy anniversary. This policy would have an annual premium of $5,820. So that's their joint premium. So decent premium. Now let's compare this to a hybrid life policy for Doug and Debbie. And here I'm going to look at the hybrid policy where the emphasis is on the long-term care. There's 2 types of hybrid life policies. The very basic hybrid life, the emphasis is on the death benefit. So the death benefit and the long-term care policy are the same. These policies have an acceleration of death benefit rider on them, so you can accelerate the death benefit early if you've been diagnosed with those 2 triggers we talked about earlier. There's no option to add an inflation rider. And then the second type of hybrid policy, what I call a true hybrid, is the emphasis is on the long-term care benefit. There's a small death benefit, and we can design it to be very similar to the long-term care policies. So what I mean by this hybrid life, we have flexibility to design the long-term care benefits to be very similar to a traditional long-term care policy. We have a choice of monthly long-term care benefits, choice of benefit periods, 2 years, 3 years, 4 years, 5 years, 6 years, up to lifetime. Inflation protection, 3% and 5%, simple and compound, depending on the product. Small death benefit, because again, the emphasis is on the long-term care benefit, and many of them have some cash value. So down the road, if the client needs some money or they change their mind, they can get some value out of the policy. Now let's look at an individual hybrid life policy for Doug and Debbie. Again, we want that $5,160 monthly benefit. Hybrid life, 3-year benefit period, 90-day elimination, 3% compound. By plugging in this monthly benefit, we would have a death benefit of $123,000 $840. So again, these are individual policies. So they would each have their own policy with these benefits. So the hybrid life, this is the quote I ran is with Nationwide. You have a choice of level premiums. So level lifetime premiums pay to age 100. The premiums for Doug, $5,184, Debbie, $5,576. Then a 10 pay, so they would pay a premium for 10 years, $8,800, $8,600. Or if they wanted to pay single lump sums, just over almost $72,000 each. So choice of options for them. I'm just showing you here the most common options. I would say the majority of hybrid policies that we sell would be a 10 pay. Now let's look at a joint hybrid policy for Doug and Debbie. Nationwide came out with this joint hybrid policy this year, and it's a very nice policy, very nice product. So it's a second to die permanent life insurance policy with a long-term care rider. Pays a death benefit upon the second death. And I should mention the hybrid life policies, as you receive long-term care benefits, the death benefit is reduced dollar for dollar. Some of them do have a guaranteed minimum death benefit. So even if you go through all your benefits, your beneficiaries are guaranteed to receive a small death benefit. This joint policy does provide both of them with long-term care benefits. They could both be on claim at the same time, receiving benefits. If they are, they'd be using 2 months of benefits. Multiple benefit period options, 48 months, 72, 96. So they would share these benefit periods. Inflation protection available, 3% and 5% inflation. So a joint hybrid life policy for Doug and Debbie, let's see what it looks like. Again, I ran this quote for the same monthly benefit, and we went with the 72-month benefit period. So 6 years to share between them. So very similar or the same as those other two products, the traditional long-term care and the individual hybrid, same 3% compound inflation. With the hybrid policies, the only option for elimination period is 90 days. This policy would have an $185,760 death benefit paid upon the second death. So these are the premiums, level, 10 pay, and single premium. This is their joint premium. So a level premium, $8,687, 10 pay, $16,150, or single premium, $133,948. You can see these premiums are less for the majority of the time. It's less to get a joint second to die policy than the two individual hybrids. Next option, let's look at a hybrid annuity for Doug and Debbie. So what is a hybrid annuity? It's a fixed deferred annuity with a long-term care rider. The long-term care pool, 102 months. Very minimal underwriting. We talked about this earlier. There is some underwriting, but it's very minimal. Only way to fund this is with a single premium of non-qualified money. Can add a spouse to the annuity. So we can do an individual or we can do joint, and we can do a 1035 exchange. So this is a nice product where you have clients, maybe you have a couple, and maybe one of them has a life insurance policy with some cash value, and they no longer need that death benefit, but they want long-term care benefits, or they want a long-term care plan for the two of them. So with this hybrid annuity, the 1035 exchange rules will allow us to add on a spouse. So if we have a husband and wife, the husband has some cash in their life insurance, we can roll it into the hybrid annuity, add the spouse on as a second annuitant, and they can both have coverage. 1035 rules will not allow us to do that with a hybrid life policy. It's just the hybrid annuity. Non-qualified funds only. We do have the option to add 5% inflation rider on the policy, but it's only on a portion of the annuity. We cannot add an inflation rider on the base benefit. Only the, we can't add it on, I think it's the first 32 months, only the continuation of benefits rider, which gets confusing. So for in this case, I'm just showing it without the inflation rider. The closest I can get to the benefit that we wanted is $5,193 monthly benefit. 102-month benefit period, so they can share that, 90-day elimination, and no inflation rider. Premium required $152,000 lump sum. Now let's compare all three of these. All four of these products. So here we're looking at traditional long-term care, the individual hybrid life, the joint hybrid, and the joint hybrid annuity. And we're going to say they both, Doug and Debbie, both go on claim in 30 years. So after paying premiums for 30 years, they would have paid in almost $175,000 for the traditional long-term care. Remember that premium is not guaranteed. So I'm just assuming they've had no rate increases. They may have had some rate increases, but we don't know what they're going to be. So for now, we're just going to do the $174,600. The hybrid individual, very similar premium. The joint hybrid, a little bit less. And the lowest premium is that joint hybrid annuity. But again, that hybrid annuity has to be single premium. What long-term care benefits do they have in 30 years? The first three products, very similar long-term care benefit because they all started similar and they all have the 3% compound inflation. The hybrid annuity has grown slowly because the annuity does receive some interest. It does not have that guaranteed 3% compound rider. Total long-term care pool, again, the first three are very similar. That joint hybrid annuity is less. How about cash value? No cash value in that traditional long-term care. Again, this is individual policies, so I'm showing the individual cash value in Doug and Debbie's policy, so nice cash value. The joint hybrid has some cash value in year 30. The highest cash value is that hybrid annuity because you're starting with the largest initial premium, that lump sum. Death benefit, again, no death benefit in the traditional policy. Individual has 2 death benefits because 2 policies, the joint, and then over here, when I say under the hybrid annuity, that's the annuity value. So it's kind of like a death benefit, but it's the annuity value. All these death benefits, we're assuming that they have not gone on claim at all. Policy type, traditional long-term care and the hybrid annuity are reimbursement. So they have to submit bills. All care has to be by formal caregivers. The hybrid life policies are indemnity, so cash benefits. So in summary here, if your clients, their main concern is having a good long-term care policy, a good long-term care benefits, they can't afford those high upfront premiums, but they could do lifetime premiums. Traditional long-term care is still a very good product for them. So your clients that are single, they don't have any children and they don't care about leaving a legacy to anybody. They don't care for a death benefit. That traditional long-term care is a very good option for them. Your clients that maybe want 2 death benefits, then they might want to go with the individual hybrid policy, hybrid life policies. Clients that like the hybrid life want to pay a lower premium, that joint hybrid life may be a good option. And the clients that have a big lump sum that they're willing to put into a hybrid annuity is a good option. You don't receive as high a long-term care benefit, but it's still a decent benefit, has a good annuity value and some cash value. So that's a summary of those different products on the market. So let's switch gears here and talk a little bit about long-term care rate increases. If your clients have some old long-term care policies, they may have received some rate increase letters, especially if they have Genworth policies. And why have we experienced, or why has the industry experienced these rate increases? Well, there's several factors that have contributed to this. Lapse rates, policy lapse rates, interest rates, and underwriting. So let's look a little bit closer at this. So in the 1980s and 1990s, when the long-term care policies came on the market, they were a new product, and the actuaries did not know what to expect for lapse rates. So they anticipated a 4% lapse rate. So they thought 4% of the policyholders would drop their policies before they went on claim. So let's simplify that. So if they sold 100,000 policies, after year one, if they had 4% lapse rate, they would have had 96,000 policies still on the books. After 5 years, 81,500. After 10 years, 66,500. So again, to simplify this, if the insurance company needs $100,000 per year to pay claims benefits, they could charge everybody $665 because they're anticipating they're only going to have to pay out on 66,500 policies because they're anticipating a lapse rate of 4%. So they're thinking only 66,500 will be in place in 10 years. Well, what happened? Lapse rates were actually closer to 1%. Many more policyholders held on to their policies. They didn't lapse them. So that put the insurance companies in a bind. So with only 1% lapse rates, there are a lot more policies on the books. So out of 100,000 policies after 10 years, 90,400 policies on the books. So if the insurance company should have been charging $904 per policy, but they were only charging that $665 because they are anticipating that 4% lapse rate. So you can see they didn't have enough money to pay for claims, so they had to increase the premiums. Another thing is interest rates. So the insurance companies collect money, or they collect the premiums. So, and then they invest those premiums, make money on it, so they can pay out claims in the future. But the premium calculation determines how much to pay in claims. Part of pricing the premium is interest rate assumption. Well, in the 70s or 80s, interest rates were very high, and the actuaries anticipated that interest rates would stay high levels. But as this chart shows, and as you all know, interest rates had gone down very low. They were down for decades, very low, and they stayed low for a very long time. So insurance companies didn't earn the interest on their premiums that they had expected. So again, that's another factor contributing to the need for increasing premiums. Another thing to look at, a cause for rate increases, underwriting. Being a new product, a new type of insurance, there was no good data on significant health conditions that would cause long-term care claims. They didn't know what would contribute to claims. Many people who were approved for policy decades ago, if they had applied today under today's guidelines, it would have been different. Many policy holders or applicants would have been postponed because the insurance companies now often require some length of time for stability, especially after somebody's had some physical therapy. Usually if somebody's had physical therapy in the last 6 months, they have to wait to apply. They have to wait another 3 to 6 months before they can apply because the underwriters, they want to see that that physical therapy was effective. They want to see that the condition that the insured had is now resolved. If they've had a diagnosis, maybe they've had a diagnosis of depression and they've been put on medication, they want to see a stability period of at least 6 months. So, or if they've been on depression medication or anxiety medication and have had a change in dosage, either up or down, again, the underwriters want to see some stability. So if somebody applied today, now they might have been approved, but at a higher rate, a higher premium. Or somebody that applied before, if they applied now, they might have been offered a limited benefit. They would have been approved, but offered a limited benefit. Mutual of Omaha, they have 3 underwriting classes. If somebody qualifies for the 3rd class, they're going to be limited to a $5,000 monthly benefit. Or family history. If they have one immediate family member with some cognitive issues, they're going to be limited to a $5,000 monthly benefit. Or they may have been declined altogether if they applied now. So the good news is with today's policies, they're priced better. They have more exponentially more claims experience. The industry has matured. The actuaries have a better idea on what claims are going to be. And today's policies, they're using lower interest rate assumptions. So they're anticipating the lower interest rates, and the underwriting is stricter. So there was a survey of actuaries, the Society of Actuaries, and what many of the actuaries are saying is the chance of long-term care insurance premiums increasing now is less than 10%. And if there is a need to increase, the Society of Actuaries say the increase would likely be 10% or less. So I think we're still going to see more rate increases in the future, but I don't think that we will be as high or as often. So I think you should prepare your clients to be ready for a rate increase, but certainly not every year and not as high as the past. So if your clients have a policy and they've had some interest rates, there are some things, if they've had some rate increases and they receive a rate increase letter, there are some ways you can help them look at their current policies and maybe reduce the benefits, keep that premium low. They could look at the inflation rider they have. So if your client has an older policy and has a 5% rate increase on it, 5% inflation rider, and maybe they're in their 70s or 80s now, that inflation rider may not be as important as it was when they were in their 50s or 60s. So look at their daily or monthly benefit and see how it compares to cost of care in their area. And if they've got 100% of care covered or more than 100%, maybe they can take that inflation rider down. Not always do the insurance companies let them take it down to like a good level, like a 3 or 4%. What I see a lot of times is they can take it down to 1% or take it off totally. But again, look at what their current benefit is, and maybe they could afford to do that adjustment. Maybe reduce their benefit period. A lot of the older policies were sold with unlimited benefit periods. Not many people need unlimited benefit periods. If they don't have any family history of cognitive issues, maybe they could consider reducing that down to a 5-year benefit period. So remember I said earlier, only 20% of claims last more than 5 years. And then they might want to reduce the benefit amount. Look at cost of care, see how their current benefit compares to current cost of care. Maybe if they reduce their inflation option, keep their benefit where it is. So maybe not reduce both, or keep their benefit amount and take that inflation option. So just look at the overall picture. And we're always happy to help with that. If you want a policy review, we're always prepared to look at these policy reviews for you. Now I want to do a quick update. About a month ago, Mark did a quick webinar on California and California looking at the possibility of passing a public long-term care plan. So just wanted to give you an update. So what do you need to know? So California created a task force via Assembly Bill 567 in 2019 to recommend options for designing and implementing a public long-term care insurance program, and they produced 2 reports. Feasibility report was submitted to the California governor and legislature in December of 2022. So then they decided they needed an actuarial report, and we're waiting. The state is still waiting to receive that report, and it's to be submitted by January 1st of 2024. So the reason they're looking at this is the state wants to take the pressure off of Medicaid. They realize that they have, the population is aging, and it's going to be a lot of strain on Medicaid. They want to have another program in place, even if it's a small long-term care plan, that their residents would use that long-term care plan before applying for Medicaid. So the task force, the first task force recommended various possible structures for a public program. I believe they came up with 5 programs, and now they want to look at the feasibility. They looked at a different funding mechanism. One potential means of funding a program is by instituting a payroll tax on California employees, very similar to what the state of Washington did a couple of years ago. The state of Washington is charging a 0.58% salary tax on all W-2 employees in the state, and they started collecting that tax in July of this year. So California is looking at a similar plan. We're not sure exactly yet what it will be. The task force has recommended that consideration be given to allowing residents who have a qualifying private long-term care policy in place before this tax goes in force to opt out of this public program. So that means that if they have a policy that qualifies to opt out, they would not have to pay that payroll tax. It is possible that only policies purchased prior to a certain date were qualified to allow a resident to opt out of the program. In the state of Washington, they gave residents a window after the bill was passed. They gave them a window of several months to put a private long-term care policy in force and enable them to opt out. So there is talk that California will do that, but not have a window. They might have say, okay, you have to have a policy in force by the end of 2023. So again, it's the unknown. We don't know what's going to happen. So as of today, the legislature has not received the task force final report, has not decided to implement a public program. The legislature has not decided what date, if any, would be the cutoff date for purchasing a private policy, among other major policy considerations. So the California Insurance Commissioner has said, in short, the legislature has not made any decisions about a public program at all. No payroll tax is being implemented, and there's no out date at this time. So that's key, at this time. So we recommend you talk to your clients in the state of California and tell them what is in the works and what could happen. And it'd be very important for them to plan ahead of time. So which clients is it most important for you to talk to first? Well, talk to your clients that are large income earners, because they're the ones that are going to be taxed the most. In Washington, there was no cap on that tax. So age 18 up, residents have to pay that tax, 0.58%. So talk to your clients that are younger, maybe in their 30s, 40s, 50s. These are the ones that are going to work the most years and therefore have the most time to have to pay that tax. So the higher income, the higher amount of tax they're going to pay. So concentrate on these clients. If we're using the Washington state tax of 0.58%, we don't know what California is going to pass. And since there's no plan as of today, if we look at what Washington did, we put this chart together to give you an idea what income levels your clients would be better off by purchasing a private long-term care policy instead of paying a tax. So here, what we're saying is, if you have a couple, male and female, if they purchased a policy with the minimum benefits needed to opt out, $100 a day, 2-year benefit period, that's the lowest benefit period that's available. And we suggest they add a 3% inflation rider onto the policy to make it a decent policy. So if they purchase a policy, and we're saying if they're both at age 30, their joint premium for the private policy with Mutual of Omaha, $2,202. If their joint income is equal to or greater than $379,000, they would save money by purchasing and paying the premium on the private long-term care policy than not buying that policy and paying the tax. So at age 40, if they purchase the policy, premium is just a little bit higher. And if their income is $392,000 or greater, they're going to save money by buying a policy. And you can see with NGL, look how much lower their premium is. NGL is not available until age 40. So again, if their income is $255,000 or greater, they're going to pay more in taxes if they don't purchase a policy, and age 50 on up. So again, talk to your clients in California. We don't know what's going to happen, so better to be prepared and be ready in case the tax does pass. That's it. Thank you, everybody, for paying attention today and tuning in. If you have any questions, please let me know. And I'm looking to see if there's any questions here. At this point, I don't see any questions.
Jill, open up your chat, and the questions are in there.
Okay. I'm sorry, Claudia, I don't see the questions. I see my chat.
Yeah, it should be under the chat, and there should be a bunch of questions that.
I apologize, I was at the bottom.
Yeah.
Okay, I've got a question here. What about the fact that clients seem to get letters saying to pay a doubled premium every 3 years to maintain the same daily maximum benefit? So they're asking if your clients are policyholders and they receive a rate increase letter, and every 3 years they're having a rate increase. So this is where you should look at their current benefits and see how their benefits compare to current cost of care, and then determine if they can afford to reduce their benefits. So maybe they have a policy that has a current daily benefit of $330 and cost of care in their area is $250. So they could consider reducing that benefit amount and still having 100% of cost of care covered. So this goes back to where I talked about looking at their benefit period, their inflation rider, and their benefit amount. Next question, how does the 100-day Medicare coverage tie in with the elimination period? Some companies will allow you to start to go on claim right away. So Medicare will pay for 100 days of care. If you've been in a hospital and received care for 3 days or more, and when you're released, the doctor says you need skilled care, Medicare will pay for 100% of your care for the first 20 days. Day 21 to 100, you have to pay a copay. After 100 days, Medicare will not pay anything. So some companies will let you start that let's say you have a 90-day elimination period. They'll let you start that elimination period day one when you're receiving benefits from Medicare, so that then once Medicare is done, you can start to receive benefits if you've satisfied that elimination period. Some companies will not let you do this, but you have to check with the insurance company to see. Okay, question is, I've heard that it is difficult to go on claim for dementia because people can still technically do all 6 ADLs. Please comment. So if they've been diagnosed with dementia and eventually they'll get to the point that they are a danger to themselves, maybe they're going to wander away or they're going to do something harmful to themselves, stop, forget to take their medications or overdose, then eventually they should be able to go on claim. They may still be able to feed themselves, dress themselves, but eventually, majority of time, the dementia advances that they will be a danger to themselves, and then at that point, they would be able to go on claim. What happens when a long-term care policyholder moves from his or her original state to another state? Which state insurance commission has responsibility for approving or disapproving premium increases? So long-term care policies and hybrids are portable. So you can take it with you when you move to another state and you have the same benefits. But the state commissioner from the state you purchased the policy in, that's the one that policy follows. So let's say you purchase a policy in Florida and you move to Georgia. If Florida has a rate increase, that policy holder in Georgia is still going to have this rate increase because the policy was bought in Florida. Given that insurance companies should be better now at predicting healthcare cost usage, do you think traditional long-term care policies will see lower premium increases in the future versus past premium increases as much as 50 or 60%? Yes, I do. As I explained earlier, the actuaries have a better idea on lapse rates. Many of the companies assume 0% or 1% lapse rate, so that's better. They're assuming lower interest rates. So I believe products are priced better than they have been. Mutual of Omaha, they had the same product on the market for 10 years. They've had one rate increase this year. They've had one rate increase, which happened to be this year and the end of last year on that product. National Guardian Life, or NGL, has had the same product on the market for 7 years. They have not had a rate increase. So I do not think we'll see as high of increases as we have in the past or as often. I think we'll still have rate increases, but not as high. Can you talk more to why a 90-day elimination period is a sweet spot? Many of your clients have at least a 90-day emergency fund available so that they could pay for the first 90 days. And when you look at a 90-day elimination period, the premium on a 90-day elimination period, the premium for 180 and 365 difference, the reduction is not huge. The difference between a 90 and a 365 day premium is pretty big, but when you look at if you went with a 365 day elimination period and you had to pay out of pocket for a whole year, you're missing out on a lot of benefits. So you really have to look as, is it worth saving a little bit of money every year to end up having to pay more in the end? It's usually not. What happens if we don't use all your yearly benefit in 6 years? Can the time be expanded or do you lose it? The time can be expanded. So let's say you have a policy with a 6-year benefit and you have a $100 benefit. If you use $100 every day for 6 years, the policy is exhausted. But if you don't use it for $100, so let's just say you use $50 every day, then the policy would last you twice as long. It would last you 12 years. So whatever you don't use stays in your pool of benefits to extend your benefit period. So does one spouse family history of dementia rule out all joint policies? No. If you have one immediate family member with dementia, Mutual of Omaha will limit the policyholder to a $5,000 monthly benefit. NGL does not limit you at all. If you have 2 family members, yes, that makes it harder, but 1, no, you're good. What happens to a linked benefit policy for non-married policyholders who no longer live together? Can unmarried partners have LTC and hybrid policies? Yes. So if they're unmarried, the rule that the insurance company generally uses is if a couple lives together, they share a home and expenses for at least 3 years, then they can have a joint policy and they can qualify for the couple's discount. If they separate or become divorced, that's their choice. They can keep the shared care rider on the policy if the 2 people agree to do that, or they can take it off, or they can, if one policyholder wants to drop their portion of the policy, then they can do that. The policyholder that wants to keep the policy now has their own policy. They just pay their portion of the premium. Please provide an update on Washington State, if time permits, and other states that may close to having a plan. So Washington State, their plan is in force. They are collecting that 0.58% tax. I think it's a couple years until you could go on claim. So residents are paying in that tax now. If somebody became sick and would meet the triggers, they cannot go on claim yet. I think it's 2 or 3 years that they have to pay into it before they can go on claim. The state of Washington is looking at changing the policy, the plan a little bit. When the plan was implemented, there was no check-in period. So initially, if you purchased a private long-term care policy, you had to check in with the state's website and prove that you had a plan so you could opt out of the tax. But the state was not going to go back to policyholders to see if they've kept that plan. But the state now is looking at implementing a check back period. So they may go back to policyholders and look to see that they've kept that policy. But as of now, the plan is in action. In California, if you pay in and move, can you still get the benefit like Social Security? So we don't know yet. In Washington, if you paid, in the state of Washington, if you paid into the plan and then moved out of state, you could not take any benefits with you. I think they're considering changing that, but initially, if you paid in and then moved, there's no benefit. So we don't know yet what California is going to do because nothing has been approved yet. I'll read one more question. For Washington state private insurance versus payroll tax, isn't the private insurance more than double the benefit of the Washington Cares benefit? It is. The Washington Cares benefit, the Washington plan only provided 1 year of benefits. So it was $100 a day for 1 year of benefits. If you purchase a private long-term care policy, the lowest benefit available is 2 years. So if you purchase a private policy, you're receiving twice the benefits. I'm sorry, we're out of time. So any questions that I have not had a chance to answer, we will make note of them and I will send you a private email with the answers. Thank you again for all tuning in today, and y'all have a good evening. Thank you. Bye-bye.